Welcome back to Market on Close here on this Friday. 9 straight up days for the S&P 500. One name that was unable to fully participate was Amazon, but stock erased a lot of its losses from its initial reaction to earnings. For more on those earnings, we're joined now by Arun Sundaram, equity research analyst for CFRA. Arun, talk to me about your takeaways. It seemed like there was the big red, beware of the guidance for operating income. But other than that, it seemed like there was a lot to like from Amazon for the quarter and the future. Your thoughts?
Yeah, exactly. I thought it was a very strong, respectable quarter. It just wasn't that home run kind of quarter that we saw from Microsoft, who reported the day before. I think if Amazon reported ahead of Microsoft, the stock would have been up. But expectations were pretty high coming into this earnings because of the strong growth at Microsoft Azure. If you recall, Microsoft Azure saw growth accelerate from the previous quarter to this quarter. But for Amazon, its AWS business, it posted 17% growth, which was in line with consensus, but it did mark a 2 percentage point deceleration from Q4. I think that disappointed investors a little bit. And then, of course, the guidance. But I think everyone typically takes Amazon's guidance with a grain of salt because they tend to guide conservatively. In the last few quarters, Amazon has beat above the high end of its guidance. So I actually thought the guidance could have been a lot worse. And overall, we thought the quarter was pretty strong.
Yeah, and I felt like the guidance actually for all the metrics outside of maybe what could represent margin compression basically said no deceleration. It was almost just that they thought based off that operating income number that they might be eating some of those trade-related costs. But correct me if you saw it differently. I want to get your thoughts, though, on how you assess a company like Amazon. They got this retail business. They got, of course, their advertising stuff that they're building out. But then they got AWS and they got the cloud. Two so different of businesses, both so important to the company. But do they provide a little bit of resilience in this kind of uncertain time frame that maybe AWS will be less impacted by tariffs, despite the fact that maybe the retail might?
I actually think all their businesses are relatively resilient because they are the #1 market share leader in e-commerce. They're also the market share leader in cloud computing with AWS. And they have one of the fastest growing advertising businesses right now as well. And advertising is actually a higher margin business than both e-commerce and AWS. And so the good thing for Amazon right now is that AWS in advertising is growing faster than its e-commerce business, which is good for overall margins because those are very high margin businesses. At the same time as they're continuing to unlock margins through its finding efficiencies in its fulfillment business and things like that. So even with tariffs in the picture, you could still potentially see Amazon continue to grow operating margins because of all these levers it has. I think that's what we're pretty optimistic about, is that we'll likely continue to see operating margin this year, even next year. Maybe that forecast might need to come down a little bit because of tariffs, but we'll still likely see operating margin expansion over the next few years.
Arun, they said they're still very aggressively investing in AI. That should be no surprise, right? I mean, that's the name of the game for these big hyperscalers.
Right. Yeah, we expected them to reiterate their CapEx outlook. They didn't explicitly reiterate it, but they did talk about how they're continuing to invest in AI. So we're forecasting above $100 billion in CapEx this year. The bulk of that's going to be AWS and AI, but they also are throwing a lot of CapEx into its fulfillment business. They're trying to expand their same-day fulfillment centers, especially in more rural locations, to try to get faster delivery out to rural America. But yeah, the bulk of it is going to be in AWS and AI. And it makes sense because right now there's more AI demand than capacity. So if hypothetically Amazon had the AI capacity today, the AWS figure that we saw last quarter of 17%, it could have been much higher. And hopefully by the second half of this year, that demand supply picture will come more into balance. So there is some optimism here that we could see AWS growth reaccelerate in the back half of this year.
Outside AWS, outside of AI, is the part we should be talking about is this blossoming advertising business that they've got brewing over at Amazon?
Yeah, exactly. I think that's the next pillar. That's been the next pillar of growth for Amazon. A few years ago, they weren't even breaking out advertising in their earnings release, but now it's become such a large portion of their business that they are breaking it out. And like I said before, it's a very high margin business for Amazon right now. Much of the advertising growth, or most of the advertising growth, is from sponsored ads within its e-commerce business. They're still very early days in video advertisements, specifically tailored to Prime Video. Last year, they just introduced ads to Prime Video, but it was at a more of a test and learn phase. This year, they're ramping up ads in Prime Video. They're getting into live sports, Thursday night football, Champions League, all these live sports that they're getting into as well. So I think over the next 3 to 5 years, we'll likely see pretty strong growth in that video advertising part of Amazon's business. And like I said, we're pretty excited about the fact that advertising in AWS is growing faster than the e-commerce business, because that's good for overall margins.
Arun Sundaram, appreciate the insights and the review of what was a strong quarter from Amazon, regardless of the street's, performance in the stock price here. Appreciate it. You have a great weekend.